There was a moment in 1637 when a single flower bulb in Amsterdam cost more than a fully furnished mansion on the canal, and nobody thought that was strange, because by that point, an entire nation had convinced itself that flowers were the future of wealth, and if you questioned it, if you dared to suggest that maybe, just maybe, a tulip shouldn't cost 10 times what a skilled craftsman earned in a year, people looked at you like you were the crazy one, because the price kept going up, and everyone who bought yesterday was richer today, and everyone who bought today would be richer tomorrow, until one morning in February when someone tried to sell and nobody bought, and within a week fortunes that had taken generations to build evaporated like morning fog, leaving behind only debt and the kind of collective shame that a nation doesn't talk about for centuries. This is the story of the first recorded financial bubble in human history, but it's also the story of every bubble since, because the mechanics haven't changed, only the asset, and if you think this is ancient history that has nothing to do with you, then you haven't been paying attention to the last 20 years of cryptocurrency and meme stocks and real estate and every other time someone convinced you that this time is different, when it never is. And by the end of this video, you're going to understand exactly how an entire society goes insane together, and more importantly, why you're probably in the middle of it happening right now and don't even realize it. Holland in the early 1600s was the richest place on earth, not because of gold mines or conquered territories, but because the Dutch had figured out something nobody else had, which was how to move goods faster and cheaper than anyone else, through a combination of superior ships and a banking system that could finance voyages halfway around the world. And this wealth concentrated in Amsterdam, where merchants built those famous canal houses and filled them with art and furniture from every corner of the globe, and the newly rich wanted symbols of their wealth, something beautiful and rare that would signal to neighbors and rivals that they had made it, and for reasons that still puzzle historians, they settled on tulips. The flower had been imported from Turkey decades earlier, and the Dutch loved them because they were colorful and exotic and unlike anything that grew naturally in Northern Europe. But more importantly, tulips had a strange biological quirk that made them perfect for speculation, which was that they could change colors unpredictably due to a virus that created striped patterns nobody could control or replicate. So two bulbs from the same plant might produce completely different flowers, and this randomness made certain patterns incredibly rare. And rarity, as we know, is the foundation of value in markets where the only purpose is signaling wealth rather than utility. By 1634, tulip trading had moved from gardeners to investors, and this is where the story really begins, because once speculation enters any market, the rules change completely. The asset stops being about the asset and becomes about the price movement, and prices started rising in a way that had nothing to do with flowers, 10% one month, 20% the next, and suddenly everyone knew someone who had made a fortune buying tulips, and the people who hadn't bought yet felt like fools, like they were missing the opportunity of a lifetime. And this feeling, this fear of being left behind, is more powerful than greed. It's what drives every bubble to its peak. The problem was that tulips only bloom once a year and can only be safely moved when dormant, which meant you couldn't actually trade the physical bulbs for most of the year. So someone invented tulip futures, which were contracts to buy a bulb that didn't exist yet at a price agreed upon today. And this innovation, this creation of a financial instrument divorced from the physical reality of the underlying asset, was the moment the market stopped being about tulips and started being about pure speculation, because now you didn't need to own a bulb or even want a bulb. You just needed to find someone willing to pay more than you did for a piece of paper promising a bulb 6 months from now. And people did want to pay more because the price kept going up, and when the price goes up, everyone becomes an expert who can explain why this time is different, why tulips are actually undervalued when you really think about it. And the explanations in 1636 sound exactly like the explanations for Bitcoin in 2017 or real estate in 2006. They talk about limited supply and increasing demand, and how the old rules don't apply because this is a new paradigm. And if you've ever found yourself explaining to a skeptical friend why something that seems obviously overpriced is actually a steal, then you understand exactly what was happening in Amsterdam taverns, where tulip contracts changed hands over beer and promises. By 1636, a single bulb of a variety called Semper Augustus, which had red and white stripes, was selling for 6,000 guilders, and to understand what that means, you need to know that a skilled craftsman earned about 300 guilders per year, so this flower cost 20 years of wages for someone who worked with their hands for a living. Or put another way, that same 6,000 guilders could buy you a large house on the canal with a warehouse, or 8 pigs, or 12 fat sheep, or 4 oxen, or 2 wagon loads of wheat, or 500 pounds of butter, or 1,000 pounds of cheese. But people chose the flower because the flower was going up in value, and houses and pigs and cheese were not. The mechanics of how the bubble expanded tell you everything you need to know about how financial manias work. Because it started with wealthy merchants who could afford to lose money, but as prices rose, the potential profits attracted people further down the economic ladder. Shopkeepers and artisans and even servants, people who had no business speculating in flowers, but they saw their social superiors getting rich and they wanted in. And this is when things get dangerous. When the money borrowed to speculate exceeds the money saved to speculate, because borrowed money creates a ticking clock. You can't wait out a downturn when you need to make a payment next month. And everyone was borrowing, using their homes as collateral, or their workshops, or their future earnings, making promises to pay that assumed tulip prices would stay high forever, and the sellers were happy to extend credit because as long as prices were rising, the collateral was good. It's the same logic that drove subprime mortgages in 2005. If housing prices never fall, then everyone can afford the payment, because they can always sell at a profit, except of course prices do fall eventually always, because that's how mathematics works in markets built on debt and speculation rather than income and value. If you're watching this and starting to feel a cold recognition in your chest, like maybe you've seen this pattern before, maybe you're even in it right now, then you should probably subscribe, because understanding these patterns is the only defense against becoming a victim of them. And we're going to keep showing you how they work over and over, in different forms but with the same mechanics. And the subscribe button is right there, and this is the kind of knowledge that people pay consultants thousands of dollars to learn. Except we're giving it to you for free, because the more people who understand how these systems work, the harder it becomes for them to function. So help us reach more people by subscribing and turning on notifications, because what comes next in this story is going to show you exactly what happens when reality finally catches up to a market built on fantasy. The peak came in January of 1637 at a tavern auction in Alkmaar, where bulbs were selling for prices that would have seemed insane just months earlier, and everyone there was giddy with the kind of euphoria that comes from watching your net worth double every few weeks. But something shifted that night. Maybe it was one person who decided they'd rather have actual money than another tulip contract. Or maybe it was a collective unconscious realization that the game couldn't continue forever, but someone offered a lot of bulbs at what should have been an attractive price, and nobody wanted them. Not at that price. Maybe at a lower price, and that's all it took. The crash didn't happen all at once, but rather like a wave moving through the market. One sale at a lower price made the next buyer hesitant, which forced the next seller to accept even less. And within days, the people who had been competing to pay the highest prices were competing to find any buyer at all, and the futures contracts that had been the vehicle for speculation became the mechanism of destruction, because everyone who had signed a contract promising to buy a bulb in the spring at January's inflated price was now locked into a transaction where they'd pay far more than the bulb was worth if they could even complete the transaction at all, given that many had promised money they didn't have, assuming they'd be able to sell at a profit before payment came due. By March, tulip prices had fallen 95% from their peak, and the people who had mortgaged everything they owned to speculate in flowers found themselves owing debts they could never repay for assets that were now worthless. And this is where the story becomes really interesting from a legal and social perspective, because what do you do when an entire nation has collectively gone insane and made promises that are now impossible to keep? Do you enforce every contract and destroy thousands of families? Or do you admit that the whole thing was madness and void the agreements? And the Dutch government tried the second approach, declaring that tulip contracts could be cancelled for a small penalty, which meant the speculators who had bought at the peak didn't have to complete their purchases, but it also meant the people who had sold to them wouldn't get paid. The compromise satisfied nobody and solved nothing, because the real damage wasn't in the tulip contracts, but in the secondary debts people had taken on to fund their speculation, the mortgages and business loans and personal promises that couldn't be voided by government decree, and these obligations destroyed families and businesses throughout Holland. Not because tulips had ever been worth what people paid, but because credit had been extended based on the assumption that they were, and when that assumption collapsed, the credit dried. Up for everything, not just flowers but legitimate business, trade expeditions, real estate, all of it seized up in what economists now call a credit crisis, though the people living through it just called it ruin. But here's what they don't teach you in economics classes when they tell the story of Tulip Mania as a historical curiosity about irrational behavior, which is that the people buying tulips at insane prices weren't stupid. They understood perfectly well that a flower shouldn't cost more than a house, but they also understood that as long as everyone else was willing to pay more tomorrow than they paid today, the fundamentals didn't matter. It's called the greater fool theory. And it's not a theory about fools, but rather a rational strategy in an irrational market. You can make money buying overpriced assets as long as you can find someone willing to pay even more, and that works right up until the moment it doesn't, and the trick is getting out before the music stops. What would you have done if you were there in Amsterdam in 1636, watching your neighbors get rich, buying flowers while you saved your money and acted responsibly? Would you have held out, or would you have eventually convinced yourself that maybe everyone else was right and you were wrong? Maybe the old rules really didn't apply anymore. Maybe you should at least put a little money in, just to see, just in case. And that's how it starts. That's how every bubble draws in the skeptics, who become the final buyers before the crash. The parallels to today aren't subtle. We've had a dot-com bubble where companies with no revenue were worth billions. We've had a housing bubble where people took out loans they couldn't afford for houses they couldn't afford. We've had a cryptocurrency bubble where digital tokens were worth more than major corporations, and throughout all of it, the explanation is always the same. This time is different. This is a new paradigm. The old rules don't apply, but the mechanics are identical to Tulip Mania. An asset whose price is rising attracts speculators who bid the price higher, which attracts more speculators, and the cycle continues until someone asks the obvious question, which is, what is this actually worth? And when enough people ask that question at the same time, the answer is always the same, far less than we thought. The Dutch learned their lesson for a generation, but then forgot, and had another bubble, and another, because the problem isn't that people don't know this pattern exists. The problem is that when you're in the middle of it, everything seems different, the explanations seem logical, the price increases seem justified, and most importantly, everyone around you is making money. And being the person who sits out feels worse than being the person who loses money. Because at least if you lose money, you were in the game. You took your shot. Whereas if you sit out, you're the coward who was too afraid to believe in the future. This is the psychological trap that makes bubbles possible. And it's why they keep happening. And it's why they'll keep happening. Because human nature hasn't changed since 1637. We're still driven by the same fears and greeds and social pressures. The only thing that changes is the asset class. Sometimes it's flowers, sometimes it's tech stocks, sometimes it's houses, sometimes it's digital coins. But the pattern is always the same, and the people who get hurt are always the same, the ones who believed the story and borrowed money to chase returns that were never sustainable. You're probably wondering what happened to Holland after the crash. Did the economy collapse? Did society break down? And the answer is surprisingly mundane, which is that most people survived because most people hadn't actually participated in the speculation. It was concentrated among a relatively small group of traders and wealthy merchants who could afford the losses. The economy, as a whole, kept functioning because tulips weren't actually important to the economy. They were a side bet, a casino game that ran parallel to the real business of trade and manufacturing and agriculture. And this is why the crash didn't destroy Holland. But it did destroy individual families and serve as a cautionary tale for future generations who forgot the lesson anyway. The real legacy of Tulip Mania isn't economic but psychological. It proved that entire populations can be gripped by collective delusion, that rational people can make irrational decisions when caught in a social feedback loop, that markets can become disconnected from reality for extended periods, and most importantly, that these episodes always end the same way, with people asking how we could have been so stupid, how we could have believed something so obviously false, except we did believe it, because in the moment it didn't feel false, it felt like the future, and that's the danger. So here's the question. You need to ask yourself right now, honestly, what are you holding or buying or believing in whose value depends entirely on someone else being willing to pay more than you did? Is it stocks that don't pay dividends? Is it property that doesn't generate rent? Is it currencies that don't represent anything except collective belief? And if the answer is yes, then you need to understand that you're playing the same game the Dutch played in 1637, which doesn't mean you'll lose. You might get out in time, you might be the person who sells to the greater fool, but you need to know that's what you're doing, and you need to have a plan for when the music stops, because it always stops. The collapse of 1637 teaches us that there's no new paradigm, there's only old patterns with new names, and the people who survive are the ones who recognize the pattern before it completes, who understand that when something seems too good to be true, it's because it is. Who? Remember that value and price are not the same thing, and that markets can stay irrational longer than you can stay solvent, as Keynes put it centuries later, but eventually rationality returns, and when it does, the people holding overpriced assets discover that their wealth was always imaginary, built on the collective hallucination that something worthless was valuable because everyone agreed it was. If this opened your eyes to how these patterns work, if you're starting to see them everywhere, you look in the markets and the news and the investments people are telling you about, then you need to watch what we release next, because this is just one example of a pattern that repeats throughout history, and understanding the pattern is how you avoid becoming its victim. So subscribe now, turn on notifications, and get ready for the next episode where we're going to show you another time an entire economy bet everything on a lie, and what happened when reality came knocking. This is the kind of education they don't want you to have, which is exactly why you need it. So click that button and let's continue this journey together.